Broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. Welcome to our Investors Observer Members Only Workshop. We do these once every 3 weeks. My name is Bobby Rains. I'm the Senior Analyst here at Investors Observer. So let's get started. All right, we're going to have a brief discussion of what's going on in Investors Observer. Then we'll do our regular sort of market update. And then the rest of the time is for member-driven content, which is questions about the website, questions about the stock market, questions about options, that sort of thing. Yeah, as always, if you send in questions ahead of time, I can prepare slides. We only got one question ahead of time. Thank you to Kavork. I'm not sure if he's here yet. He sometimes just listens to the recording, for sending in a question ahead of time. But yeah, in the future, I'm always happy to do that. If you just reply to that invitation email, it will come to me and you can type your question in there, and then I can put together a slide or two about your question. All right, so with that, what's going on at Investors Observer right now is we're calling the Stocktoberfest. We're running a stock picking contest every day. There's a daily mug giveaway and then a grand prize for giving the most correct. The mug you get every day is this guy here on the right, and then everything in this picture, minus the beer, is what you get in for the grand prize, which will be for giving the most correct. If you want to play, you can just go to this orange Stocktoberfest 2020 button here at the top of the screen. You pick your stock. Yeah, so you can see here, Berkshire Hathaway beat Jefferies Group in today's matchup. Tomorrow we have the board game meeting. We tried to pick autumn or fall themed things. So we got board meeting, football, parkas. So you can pick, just click the thing there and you can change it if you want. I think you can pick like a week in advance. But yeah, go do that, have fun. Yeah, do that, have fun with it. We had fun coming up with it. I hope you enjoy playing it also. All right, let's go back here. All right, so that's what's going on right now. We have a couple of other cool new features we're working on that we may or may not have before our next workshop in 3 weeks, but we do have some fun stuff to show you sometime soon. All right, I don't have a ton of exciting things to say about this chart. This is just the chart where we usually start. A year of daily candles on the S&P 500. Pull my notes up here. Yeah, so, September was what technical analysts would call not great in terms of, just going down for most of the month, but we're starting to come back a little bit now. Once again, a lot of times you look at the steepness of lines, and yeah, things got kind of nuts toward the beginning of September, late August, early September, and then when that happens, you get a correction. So things went down and bounced off the 100-day moving average there, and now they're back above the 50-day, and things seem to be sort of on track. We'll talk a little bit about what's driving the market in a few minutes. So yeah, this is a year of the S&P 500 versus the S&P 500 equal weight. So the equal weight's in blue, and the difference here is basically instead of being market cap weighted, the equal weight is equal weighted, as the name implies. So this just shows you how much the things like Apple, Microsoft, both versions of Google, Facebook, those 5 or 6 big stocks at the top of the market that have been going up while other things have lagged, have really, pulled the broad index higher and left a lot of stocks behind. And so speaking of leaving a lot of stocks behind, we've been talking a little bit in some of the blog posts and other stuff that we post on a regular basis on the website about, sort of things that are rising and things that aren't rising. And recently one of the things that I've been talking about is this idea of like story stocks versus economy stocks. And so we tried to put together some pairs here. We have Peloton in white versus Planet Fitness in blue. And this one is pretty close to just sort of a stay-at-home trade versus a reopening trade. Right, you can see Peloton has done very well over the past 12 months. And these were pretty well lined up until, really the spring when staying home started to be a thing and going to the gym started to not be a thing. And so, yeah, you can see Peloton has just done super well. And Planet Fitness, not so much. Disney and Netflix are kind of interesting. On a sort of functional level, they're in the same basic industry. The difference is, so there's a little bit of, new versus old. There's a little bit of reopen versus stay home. Disney obviously has cruise ships and theme parks and a bunch of other things that are sort of dead weights in this environment, whereas Netflix doesn't have any of that. Netflix is pretty asset light. They own a lot of intellectual property. But Disney even owns movie studios and stuff like that, where Netflix buys content but doesn't actually own a production company that I'm aware of. And so the other thing that's going on here is sort of a picture of scale, right? Like Netflix is huge. Everybody in the United States knows about Netflix. People around the world know about Netflix. They're in, I forget how many countries now, but it's nothing when you compare it to Disney, just in terms of the scale, right? Like Netflix, right? I just mentioned a bunch of things that Disney has that Netflix doesn't have. Netflix, there's tons of ways that Netflix can grow, right? They can expand into different business lines or whatever. Disney's going to have a real hard time growing without a growing economy, right? So that's part of this gap here, is that Disney's massive. They can't just launch a new line of business, or we're going to expand service to some country we're not in before. Disney's huge and global, and they need a growing economy in order to actually grow. Whereas Netflix has tons of opportunities to grow, just because they're not already everywhere. All right, and this next one is the real, this is as close to sort of a pure play story stocks versus real economy as we could get. It's Square versus JP Morgan. So Square does some banking-like things. They're not actually a bank, but they're a fintech company. They do payment processing. They do a bunch of other stuff. And then JP Morgan is JP Morgan, right? They're one of the 10 largest banks in the world. And yeah, JP Morgan, again, right? Like, what are JP Morgan's growth opportunities? They look like a growing economy, right? I mean, sure, they can sell a little bit more banking services than Wells Fargo or Citigroup or one of those guys that they compete with, right? They can do a little bit more investment banking than one of those guys. But in terms of like big growth to get you, something that looks like this, JP Morgan's not doing that. It's not going to happen. In order to get growth that goes up at all, they, again, right, we're talking about a growing economy, and we'll talk about this a little bit later when we talk about, things that are driving the economy and not just looking at pictures of charts. But the things that are going up are things that can expand. When I was originally looking at this, I was thinking about like Tesla versus General Motors, right? Because Tesla is small, they don't sell a lot of cars. There's no real reason for Tesla to be valued at a higher rate than General Motors, unless you believe Tesla has a chance to turn into 1955, 1960 General Motors, and really take a ton of market share away from actual General Motors. In that case, the Tesla valuation may still be a little high, but it makes a lot more sense. But yeah, that chart didn't work. Tesla has just gone up so much so fast that General Motors was just sort of a blue line across the bottom that barely moved. But that is right. Those are the things that are winning right now. Are those story stocks, right? Like Not like, oh, we expect the economy to grow and this thing does well. It's this company has a good chance to grow and here's why. And you see, we could have put almost any bank in here, and it would do the same against something like Square. All right, so what else is happening in the economy? We have had a reemergence recently of what we called Twitter-driven volatility recently. Big round trip for stocks between yesterday and today. I don't know exactly where they closed, but at about 2:30 or so, we totally erased all of the sell-off from yesterday. So that's a positive. We're really not sure there's much reason to think we won't see more of that between now and the election. That's just kind of how it is. We've played this game before with the trade war and things like that. It's things that can happen. The trade war had there were some periods where things were long-lived in terms of selling, but hopefully we won't have that this time around. If you can go down and then back up in one day, you get higher option premiums, but you're not doing a lot of damage to anything. So that's probably the best case scenario there. And then otherwise, we are, as those charts we were just looking at still, I think, make pretty clear, we're still looking at a very virus-driven economy. Cases are rising again. I've got a chart on that in a few minutes. Cold weather is probably going to push down things like restaurant spending, which could lead to a further increase in cases. You get into you could do a lot of behavioral modeling, or someone a lot smarter than me could do a lot of behavioral modeling to try to figure out what other things people might do. I'm not really sure what those are when outdoor dining goes away. And obviously you get some, Atlanta, parts of Florida, you can do outdoor dining probably year round, whereas New York, DC, places like that, it gets pretty cold to try to eat outside. So adjust for regionalities there, but and most of the restaurants we're talking about are not national chains that you're buying stocks in. Those are local things. So that's an economic impact that probably doesn't show up in the stock market directly. But that is the kind of thing that we're kind of trying to keep an eye on. And Tuesday's Twitter roller coaster really highlighted that we're also in a very sort of stimulus-driven stock market. Right? Like there were headlines all week about, we're getting close to a deal, we're getting close to a deal, we're getting close to a deal. And then Trump tweeted that talks were canceled. The Dow dropped 500 points or whatever it was. And then overnight, we're back in the stimulus game and things have come back up. And the, stimulus stuff, you noticed yesterday and today, right? Banks were up, some of that other stuff, cruise ships and airlines, those sorts of things were doing well today. That's the stimulus trade, right? It's not the things are reopening trade. That is just that's a stimulus trade. And so if we go back into there's no stimulus on the horizon sort of thing, the things that are going to outperform are the things that have outperformed all year: tech companies, your Slack, Zoom, all the work from home stuff, and stuff like Peloton. And we are, it does seem like election outcomes are starting to move markets. The president went to the hospital over the weekend, I guess Friday after the close, but the initial, positive test came out Thursday night and the market sold off on that, but went back into rally mode Monday. And a lot of investment banks and firms like Moody's and places like that are starting to put out their sort of, a lot of times what they do is put out a list of cases. If there's a blue sweep, a red sweep, and then some things in between, and they try to piece out what they think those things will mean. And generally, I've read some number of them. A Biden win means probably more government spending, balanced against probably some tax increases. Where those tax increases show up is a little bit hard to tell. He's talked about things like putting the long-term capital gains rate at the ordinary income level, which probably isn't great for a lot of investors who are doing doing, investing outside of retirement accounts. But it's hard to know what the economic impact of that is. Whereas a Trump win probably means more tax cuts, not increases. But also probably more restrictive trade policies and generally, right, more chaos. So those are sort of the things that people are balancing out. And Moody's and Goldman Sachs, notably, both in the last 2 weeks have said that they think the Biden win is probably a more bullish, better for economic growth and a wider range of stocks than a Trump win at this point. But so you can look at predicted or whatever or polling. I expect as we get closer to the market, actual poll headlines hitting the market may cause things to move. Although the polling averages have been much less volatile this cycle than they were in 2016. So we'll see. But there is a lot of times some volatility heading into a presidential election. All right. So yeah, this is the Washington Post's chart of virus cases. They were going down for a while. That earlier peak in the stock market was sort of here. I tried to parse it out. There was one, when things peaked back in the spring, they pretty much nailed the low point for virus cases. That June 8 date we've talked about a bunch of times was pretty much the low point. And it looklike the high point in the spring was the low point for virus cases. And the September, that early September, late August high was not quite the low point here, but it missed it by like a week. So we'll see how this progresses. We'd like to see that flatten out. The one thing here, deaths tend to lag cases and hospitalizations, but they do generally seem to be going down as a percentage of tests, just because we've been getting better treatment. That's certainly wonderful news, but we've seen a bunch of times in various states where cases start to rise and then economic activity goes down because people don't want to go out when they're afraid of catching coronavirus. So as the national numbers start to go up, I think it's like 34 states have rising case numbers. You'd expect some slowing there. And you can kind of start to see that in the Chase credit card spending. The last workshop we did was shortly after Labor Day, so we had this peak and then things were starting to go back down, but it's kind of trailed off, not all the way back to the level it was before Labor Day, but it's not rising as fast as it was either back in the spring or in the run up to Labor Day. So we'll kind of keep an eye on that as well. The TSA, more people are flying again, right? We got a bump for Labor Day. And then, it's just been kind of a slow grind higher. We are at down about 66% year over year compared to down 70% at the last workshop. So you could also call that up 4%, or it's not really up 4%, but it's up 4 percentage points year over year from where we were last time we talked. So that's nominally better. And the rate of change is, so the yellow line here is 0, and this is just the daily rate of change in the 7-day average. So this sort of flattening out above 0 is how you get to this, slow grind and straight line higher. Right, it's not sexy or exciting, but it's stable growth, so that's a positive. Drops below the line indicate flyers are starting to decrease again. We'll see what happens as we head into, I guess Thanksgiving is the next holiday where people will travel. So that'll be sort of an interesting comparison to see what people do and what happens there. All right, and now we are to the questions. So it looks like somebody put something in here. So Mel asked, can people ask about specific securities? I'm happy to take a look. I can look at what's on the website and we, talk about what's going on. I'm not making stock recommendations over a webinar, but I'm happy to sort of show you how to use the website and parse out what our analysis that's on the website says. In any case. All right, so the question we got ahead of time was from, as I mentioned earlier, Kavork, and he had a question about Fitbit. So Fitbit is being acquired by Google for $7.35 per share. And he noticed that people are trading options in Fitbit that expire in May of 2021, at a strike price of $10. So there isn't a firm date for the deal closing there, but Fitbit has said they expect it to be in 2020. And certainly if you're going to sell your company for $7.35, trading options at $10 seems a little bit weird. So why would somebody do that? Is there more room for Fitbit investors to gain from this transaction? So Fit earlier this afternoon was at $6.92. So if there's an offer to buy it for $7.35, it can go up basically 6.2% from here when the deal is finalized. So, you could buy a bunch of shares of Fitbit and make 6.2% when and if the deal closes. And then, I guess if the EU seems to be the main holdup for that deal. So if they hold that up or say, no, this can't happen, you may lose some money there, but that's sort of the basic strategy with buying the stock at this point. So options that expire after the deal get settled at the deal price, even those expire after the closing. So, all the options that are listed for Fitbit, May 2021, they may have some leaps that go out to January 2022 even. Those will get settled shortly after the closing of the deal. With that, assuming the deal goes through at $7.35, they get settled as if the stock price was $7.35 at expiration. So a $10 option is still going to be out of the money. A $7 option is still going to be in the money. And so things get settled that way accordingly. But so that option, that $10 May call, costs you 6 cents per share to buy, and it has a 0.7 delta. So delta means that's essentially how much the stock will gain for every dollar increase in the price, or how much the option will gain for every dollar increase in the price of the stock. So if you just multiply it out based on the delta, if Fitbit goes up by 6.2% or 43 cents to hit $7.35, you could make about 3 cents per share on that option if the stock hits $7.35 before the deal closes and the options are settled. If you buy it for 6 and you get a 3% profit, that's a 50% return. You got to buy a lot of contracts to make that particularly attractive, but 50% return is a 50% return. In reality, you probably won't get the full amount. It turns out that as the deal closes, the implied volatility goes out of the option because, right, we all know what it's going to settle at. So you probably don't make the full 3 cents, but if you make, a penny on 6 cents or 2 pennies on 6 cents, you're still talking about a double-digit return on a percentage basis. So yeah, you could buy a bunch of those options and hold them until the EU approval comes through, when probably the price goes up, because this discount here from the price, right, $7.35 to $6.92, the gap there is essentially a reflection of the market's confidence in the deal going through at that price. So some deals get announced and the stock will snap to the deal price or a penny or two below it pretty much immediately. The fact that Fitbit is 6% away, there is some uncertainty there because there's a big EU antitrust thing there. They're worried about what Google is going to do with a bunch more personal data about people. But yeah, I would expect that the EU approval would probably snap that stock price a little bit higher, and you can probably sell the options then for a little bit more than what you bought them for. And then, on the sell side, the chance of the Google deal getting canceled and immediately placed by something that takes the stock above 10 seem pretty remote. So if you wanted to sell a bunch of option contracts for 6 cents and then, just sort of hang on to that position until the options expired, you make 6 cents, right? Again, it's not sexy or exciting, and it takes a whole lot of contracts to make that actually equal any real money. But that is how merger arbitrage as a strategy generally works. I mean, there are whole hedge funds who, when those deal announcements come out, they just buy the stock for 3 or 4 cents under the offer price. And if you have enough leverage and you buy enough shares, 3 or 4 cents times a whole lot of shares ends up equaling real money. So that's kind of how merger arbitrage as a strategy works. So that seems like it's what's going on here. Like I said, it's not sexy or particularly exciting, but there are chances to make money trading those options. And yeah, you don't need a big move in the option price to make a decent return on a percentage basis at 6 cents. All right, so yeah, we didn't have nearly as many questions as we normally do. So yeah, that is the pre-submitted question. We've got 31 minutes left in the hour. So any questions anybody has, you can put them in the box there and I will get to them. All right, so let's see. All right, here come some questions. Let's start getting to these. Okay, so first question was from Mel, who wanted to look at BK and CS. So, I mean, I just spent some time talking about banks, and the growth opportunities for banks generally are, very much aligned with the growth opportunities for the economy as a whole. BNY is a little bit different because they're less a traditional bank. They do a lot of like asset management and trust management and things like that. But there's still things that tend to do well when the economy is doing well and tend to lag when the economy is lagging. So this looks not far from sort of what I would expect from a bank generally. Right, the overall score is about average. Fundamentally, it's doing pretty well. Analysts give it a buy. The price target is high. PE ratio is low. PEG ratio is about 1. Right, from a valuation standpoint, it looks pretty good. Short-term technical score is about average, which is better than the long term. And that's very much about this, sort of more recent stimulus rally as opposed to the longer term where, yeah, we've been a lot higher and somewhat lower this year, but it's been just sort of choppy, let's call it, for the last 6 months. And yeah, so analysts, this is always interesting to me. So analyst ranking, it's So these scores are all percentile ranked. So this stock scores better than 20% of stocks and still has a buy rating, which gives you some idea of how many how many things also have a buy rating or have a strong buy rating versus how many have a sell. So roughly 3/4 of the market based on this has either a buy or a strong buy, which means, all your holds and sells are in the bottom 25%, which, I guess analysts are optimistic. The other interesting thing to look at here is the position of the sector and the position of the industry, right? So financial services generally is 9th out of the 11 sectors, and banking is 125th out of 148 sectors. Right? It's less about BK than it is about how these sorts of businesses are doing generally. CS, Credit Suisse is interesting because they're a little bit more global, but it's a roughly similar story here. I guess their long-term technical score is a little bit higher, which helps raise the overall score. But yeah, we're still looking at banks and financial services, which is not super high. One thing you can do is, our sector and industry page, if you're looking for something like that, right? I mean, this is, if you've been if you listen to the first half of the presentation here, it's probably not surprising that things like technology are at the top and financial services are at the bottom. Energy is another thing, right? Like, people use more energy when the economy is growing than when the economy is not growing. So that's another one that's been at the bottom. All right. All right, so Alonzo says he's new to IO and wants to know about the option ideas. Sure. So let's go to our options dashboard here. All right, so we have a bunch of different pieces to our options offering. One of them is our managed portfolios. These are analysts pick trades and publish them and follow them to the, until they close. Let's click through here. You can look at something like ABC. So we opened this trade back in September. We had a call expire worthless last week. We sold another call against it yesterday. Some of these, Micron, we opened in February. February, it turns out, was not the greatest time to be opening long stock positions, but we're not far from profitability now through the sale of a whole bunch of calls. We sold bought a put once or twice to color the trade up to carry it over earnings. So it's been a bit of a journey there, but our analysts are managing that and following it. So if you're not confident about what to do with with these option strategies, the portfolios can be a great way to learn how to do that. And then the next thing we have is our Investors Keyhole service. We send out 4 trades here every day. Sort of different catalysts, right? We have usually one that's the news of the day, one that's an upgrade or downgrade, one that's based on insider, corporate insider trading activity, and then usually one that's unusual options activity. These are all going to be vertical credit spreads. And like I said, there's 4 of these a day. They're vertical credit spreads. And these, we send you the trade idea and these are updated, picked during the day. So they're kind of the freshest ideas, but you're on your own to manage those. And then the other thing we have is we have some algorithms that we have developed that pick option trades. And so you can get to those a bunch of ways. We have the featured trades. There's also a trade in the morning update every day if you're an option subscriber. The featured trades are going to be covered calls or short puts typically. Personalized trades, you can pick essentially sort of your preferred flavor or style from conservative covered calls to aggressive vertical spreads. I already had that clicked. And get some number of trade recommendations for that every day. And then we also have our options screener, which lets you screen for trades in one of these 7 strategies. So you can pick a strategy. I usually just work left to right. Pick a strategy, pick some sort of time frame. If you want long trades, you can put in a minimum. If you want shorter trades, you only need to put in a maximum, really. So yeah, we can do that. And then, put in other metrics for the trade if you care about dividend yield or profit, annualized return rate. Put in something like, I put in a pretty short date, so the annualized returns should be pretty high. All right, and then yeah, you can set your net debit, right? Most people aren't doing covered calls on stocks that are super expensive, so put in, say, a 75 there. You want an overall score that's at least mildly positive. Key rating is another thing that you can sort by here. So the overall score takes into account our sort of, anticipated direction for the stock. The key rating analyzes the option trade without a lot of without any regard for the directional analysis of the stock. So for covered calls, a 5 key trade is going to be the safest trade. This is going to be a trade that has a pretty high amount of downside protection in terms of where your break even is relative to the stock price. It's also typically going to be shorter than some other, lower key trades. And also the ratio of the option premium you get to the strike widths are going to be relatively close. If you saw that portfolio trade I was talking about earlier, that Micron trade, we've sold a bunch of calls against it. And one of the reasons we can do that is Micron has a lot of strikes. So if you're getting $1 or something per strike price and you need to go up or down a strike price, or $1 or something per option, and you need to go up or down a strike price, it's pretty easy if there's $1 or 50-cent strikes. If you're getting $1 every time you sell an option, you got to go up $5 or down $5 per strike price. That can be a really hard position to manage. So the key rating takes all of those things into account. And so, 5 is the one that we feel generally the best about, and 1, well, there's only 4s in this setup because of the way I have it set up, but yeah, 1s will be the least safe. You can put as many of these as you want, highs and lows, or highs or lows. You can get ones that only expire before earnings, which that's going to really cut the number down at this point in the quarter. And then you can also sort by sector and industry. And yeah, we have a similar setup for covered calls, short puts, bullish and bearish diagonals, bullish and bearish vertical spreads, and iron condors. All right, when pulling up charts, is there a way to put a price channel on it? I believe there is. I think you have to go to the big chart though. Let's see. So if you hit that view larger chart button, and then this function button here, that'll let you add indicators. Yeah, so you can do price volume trend there, or the other way people do price channels is filed away under linear regression. Once you get it up there, there's a little gear that pops up, and so you can change it to be if you want 200 days and 2 standard deviations, based off the close price, etc., you can do that. All right, so Frank says, why does it appear the high-paying dividend stocks are not doing very well compared to the high-growth stocks? Frank, I mean, to go back to sort of all the things we were saying earlier about, growing economy versus story stocks, the high-paying dividend stocks are those like, Disney is a good example. Microsoft is maybe a weird one. Microsoft actually pays a relatively high dividend. Although as much as its stock has gone up recently, that yield has probably gone down. But yeah, your high-paying dividend stocks are typically things that aren't growing a whole lot. They're not the story stocks. Those high-paying dividend stocks are the stocks that do well when the economy grows. Whereas the growth stocks are, Square and Peloton and things like that. And there's no reason if you're looking for, an above market return, there's no reason to put a bunch of money into those high-paying dividend stocks. I mean, they're certainly safe and should be part of any sort of well-diversified portfolio. But if you're trying to buy stocks that you think are going to go up in the near to medium term, those aren't, those kind of aren't the stocks that make sense to do that. And so that's why that's happening. All right. So Richard says, do I know why the jump in AMAG on October 1? I don't offhand, but our news service is pretty comprehensive, so they probably have something about it. Oh, there you go. AMAG Pharmaceuticals to be acquired by Covis Group for $13.75 per share. So here you go. This one's a lot closer. Okay, the offer is for $13.75 and the stock is now trading at $13.30. So that's, about 45 cents, which is a much smaller percentage than that Fitbit Google deal we were looking at earlier, which suggests a higher confidence from the market that the deal will be completed at that price. Yes, the option ideas, well, outside of the investors keyhole trades and the portfolio trades, which those are updated by our analysts as we publish them. Option ideas in the screener are based on the previous day's close. Okay, so Mel says, does the return on stocks, I assume this means including dividends, make a difference in your long-term thinking? It certainly does, right? Like dividends are, certainly part of a return. But even so, if we looked at, if we go look at the stock screener here, let me just make sure I have everything cleared out. Yes, if we sort by the overall score, which should give us the stocks that have been, going up the most and also have decent fundamentals, right? We're going to go probably a couple pages before we find, well, all right. So we got to go to the second page before we find one that pays any dividend at all. And we're at, I'm not sure what number this is, but we're down a ways before we get to a 2% dividend, which is not bad in this environment. It's certainly higher than the 0.7% that the 10-year is paying, but it's not great. And if we sorting by high dividends is always a little bit fraught because you get things that have gone down a lot and probably just haven't cut their dividend yet. But yeah, these are not growth companies, let's say. Yeah, I mean, there's coal, you know, other things related to the energy market, which, as we talked about, energy is at the very bottom of our, sector rankings. Yeah, big box retail. This is, yeah. So dividends certainly, can come into account, but like investing for dividends right now aren't going to get you a market beating return. In some environments it will, but this is not that environment. And that goes back to that chart we looked at. I think it was the second chart with the the S&P versus the S&P equal weight. If we go back to the market cap weighting here. Still on page 2. Yeah. Our big companies aren't paying a lot of dividends right now, and these are the things that are growing. And yeah, I mean, like we said, the banks and things like that just aren't growing very fast. They are paying dividends, but they're not allowed to raise their dividends right now. So yeah, it's just not a great market for dividend investing. Which is not to say that that won't return, or that dividends shouldn't be, probably part of your portfolio. It's just not the strategy that's winning right now. All right. So Raymond says, do we follow the NVIDIA buyout of ARM in Britain? I'm aware of it. Let's say I haven't followed all of the details, but it's not. This isn't news to me. So any position in the stock is in question until the Brits sign off on it. I don't remember exactly when that deal was announced, but NVIDIA is the acquirer here. And so there's a lot less risk on the acquiring side, just because you either get the company you were trying to buy, or you keep the money you were going to spend on buying the company. If you're looking at the stock of something that's being acquired, like we talked about, the stock goes up because you have to offer to buy a company for something higher than this current stock price. So the price goes up. If that deal falls through, that offer to buy the stock at that price goes away. The stock usually falls. But on the acquirer side, a lot of times, in some cases, the stock will actually go up if a deal falls through on the acquirer side. I don't necessarily expect that to be the case here. But yeah, I don't think there's a ton of risk to NVIDIA in terms of not being able to make that. I think there's some risk in terms of not being able to make the deal happen, but I don't think it's going to have a huge impact on the stock. So Dinkar asked, do we send specific option trades daily and where to find them? So there's a covered call trade in the morning update every morning. That's in your morning update email. You can also find it on the website here under morning update. You can see these get posted. Yesterday was a little bit late, but usually we're between 9:20 and 9:40. We also have, as we just discussed, the investors keyhole trades. There's 4 of these a day. If you go to the options dashboard and click investors keyhole, they're also in your email. You can change your messaging settings here. If you want all of them, or there's just 1 or 2 you want, you can change that and do that. That's under my account and then message settings. All right, so James is curious about APH. It would help if I typed it right. This is not a company I'm super familiar with. Okay, all right, so I think James had an earlier question about the cannabis stocks. It's complicated, is the short answer. Generally, cannabis is illegal at the federal level in the United States. These companies, this one seems to be Canadian. Companies that deal directly with cannabis have a hard time even doing things like opening a bank account in the U.S. Much less obviously selling their product. So that's that certainly presents a problem. In the long term, it seems like those things are softening up. It's going to take a law change at the federal level to make that sort of, make a lot of those business problems go away. But analyzing the individual stocks here, there's so much sort of uncertainty about what's what, and even which companies are legit. 2 years ago, this question was a lot easier. I thought they were all overpriced. Now it's a lot more complicated, and I'm not sure. Yeah, it seems like they do medicinal and recreational, but yeah, I don't know what makes this stock better than any other one, and I'm not convinced if it becomes legal in the United States that Philip Morris and or somebody like Coca-Cola don't get in, and they already have all the distribution channels and everything else. So maybe they buy up some of these little guys and you can make some money there, or maybe they just stamp them out by being giant and having, the market share and the distribution partnerships. That's the thing that worries me with these stocks. I don't think there's at the end of the day, we're talking about an agricultural commodity, right? And I don't, in the same way, I don't see anybody, coming out of nowhere and just, being the hot new corn startup because it's corn, right? Like you're going to price it the same way everybody else prices it because you're either going to be too high or taking a loss. And functionally, that's what we're talking about here is some sort of agricultural commodity, and then making products on top of it. So they're really hard to value. It generally seems like a sort of growth industry, but there's so much sort of noise and, weird scams and other things that it's really hard to know which stocks are good and which are not. And I've just sort of tried to stay away from most of it because I don't feel like I have a clear picture into it. All right, so Steve says, how do we know which company is the best in each industry? Is there a numerical ranking? So the easiest way to do that probably, you can go to the sector and industry page. So the industries are here. And so this will give you the top one, and you can sort through and get the top one for each individual metric that you're interested in. That's probably the easiest way to do it by industry. And then we have a similar page. If you just click on the sector, you can find the top in the sector and look by, whichever metric you're interested in there. All right, so Robert, this and all of our workshops are recorded. We'll post a recording and a link to download the slides tomorrow. We'll post a link to that tomorrow, as well as a copy of the slides that we used and a link to sign up for the next one. And we'll also send everybody an email with a link to it, so you don't have to keep checking the site. It usually goes up about mid-morning. All right, so I think there's a couple of questions here that I will follow up with people by email about. That seems like it's most of the questions so far. Yeah, if you need to get in touch with us between workshops, this help button here fires off an email to our support staff. So that's a good way to get in touch with us. You can also call us during East Coast business hours. The number is down here at the bottom of the website. Yeah, so recorded, how to get in touch with us. Yeah, I think that's pretty much it. So yeah, thank everybody for coming. We do these once every 3 weeks. Don't be shy about asking questions. Either by phone or if you think of something in the next couple weeks, and you're like, oh, I'd like to see a couple slides about that. By all means, send it through the help button. Just say, hey, save this for the workshop. We have a couple people who do that periodically. And those are great questions. Usually my opinion is if one person has the question, it's probably a question that some other person has thought about. So it also really helps me in terms of just planning content for these things. So yeah, thank you all for coming. Thank you for subscribing to Investors Observer. Don't hesitate to get in touch with if you have a question or need anything. And otherwise, I will talk to you in 3 weeks. Thank you.